Good morning, everybody, and welcome to the second in this really interesting webinar series on the role that AI will play and the impact that it will have in three of the basic components of retail financial services that we all work in. So AI and its impact on advice, portfolio management, and investment management. Yesterday, we had a fascinating presentation from Glenn Calder of Viridian and James Warthoe of FinTalker on the way in which AI is being adopted by advice organizations. Today, we're going to move one step up the value chain and start thinking about portfolio management and the way in which portfolios are constructed for retail and wholesale investors. Mike Taylor, the editor of Financial Newswire, is the moderator for this series of webinars, Monday, Tuesday, and Wednesday of this week. And Mike will introduce today's panelists for what I know will be a really interesting session on the way in which AI can be deployed in portfolio management. But before I hand over to Mike, let me just share with you a few details about tomorrow's concluding webinar. We'll be looking at AI in investment management. We'll be looking at the way in which AI is used both within funds management businesses and, just as interestingly, the investment opportunities that AI is opening up and exposing for those who make investment decisions. We'll be joined by Cameron Gleeson from BetaShares and Monica Techer from InSync to talk about the role of AI in investment management. Future events for IMAP in March in Melbourne and Sydney is our portfolio management conference, where we'll be joined by 30 or so investment managers to talk about their view of the investment environment that we're now heading into. This promises to be a pretty turbulent year. You'll all know that there are more democratic elections this year than at any other year in human history. 4 billion people will vote in elections this year, but of course, all eyes on the Biden, Trump, or Democrat, Republican contenders in the US and the geopolitical context in which that's being played out. In July, our Advice in Action conference will focus on the transforming world of advice and the issues which the increasing number of self-licensed advisors will be facing in thinking about how to run a better business to provide better outcomes for clients. And for those of you who operate managed account programs, I'd encourage you to enter this year's Managed Account Awards. This is the 5th or 6th year which we've run this. Licensee Awards, Multi-Asset Class Awards, Australian Equities, Small Caps, International Equities, Fixed Interest, Responsible Investing this year, and a Boutique Licensees category. So we really have tried to expose best practice in the way in which managed account portfolios are run for retail investors. We had a lot of questions yesterday, and I know you'll need no further introduction to the issue of how to ask a question. We'd encourage you to ask questions, and I know there'll be a lot. So without further ado, Mike, it's over to you to act as today's moderators, introduce our presenters, and thanks very much.
Well, thank you, Toby, and good afternoon, everyone. It's great to be here for our second session dealing with artificial intelligence, and this time looking at how the technology can and will be used to enhance portfolio management. Yesterday, we looked at AI from the perspective of what it can bring to efficiency with respect to financial planning. So today's perspective is very much investment oriented. And I think it's fair to say that there are some very, very different implications. So let me introduce today's panelists, starting with Michael Strachan, from Corinella Capital Partners, who brings an extensive background in investment across all traditional asset classes and alternative investment. He's been and held CIO roles at Lucrative Super, Equip Super, and Rio Tinto Staff Super. He's been head of multi-asset class funds at Invesco Australia and County West Australia. So fair to say that Michael brings a wealth of knowledge which he can now exercise via his own company, Corinella. We also have with us Socrates Vossos, who is portfolio manager at WealthPilot, where he manages the Electra Fund, which is an AI-driven, diversified multi-sector portfolio fund. Socrates, of course, founded WealthPilot and created this capability to help financial advisors perform personalised portfolio reviews for client accounts on platform using AI. Also with us is AMP Investments Head of Portfolio Management, Stuart Eliot, who brings more than 30 years of diverse financial markets experience. He most recently spent 12 years with Pendle, where he was Senior Portfolio Manager, Multi-Asset Investments, and prior to that, Portfolio Manager of Diversified Funds. In these roles, Stuart was responsible for strategic and dynamic asset allocation, portfolio management, and investment research. This is intended to be a very interactive session, and we encourage our audience to use the question and answer facility. We're going to kick off with Stuart Eliot, who's going to give us some real life examples of how AI is being used by his team and how it is likely to be part of the process in 5 years' time. So over to Stuart.
Thanks, Mike, and hello, everyone. So at AMP Investments, we operate as a multi-manager, and what that means is for the $70 billion worth of savings that we look after from the AMP Super Fund and on the North platform, our role in that is to set the asset allocation for all of the different funds according to the various risk profiles, and then we determine the characteristics of the building blocks we use to actually populate those asset allocations, and then we implement those building blocks with a combination of specialist managers. So as you can imagine, we have a broad range of asset classes in the portfolio, and the managers that we use have a range of different investment approaches and skill sets, and I've had some fascinating conversations with many of them in the last month or so preparing for this panel discussion, and it's really interesting to see what they're doing with artificial intelligence. The managers that I spoke to, the way that they're using AI basically falls into two camps. One is language-based tools, and the other is price-based tools. So if we're thinking in terms of what you can do with applying AI tools to language, language is highly predictable. So you sort of think of everything that is printed in the public domain is a potential data point for training these large language models. So think of books, magazines, websites everywhere. And it's kind of like a really sophisticated version of the autocomplete that you would use on your phone or your email. So if you think about how often the suggested next word or phrase is actually what you were going to type, it's about 90% of the time. And that's because these models are just trained on the way that we write as humans. What is the syntax? What's the structure? What's the inference? And you can see something like GPT-4 is trained on 100 trillion parameters. And so because it has so much data available to actually train it on, its predictive power is quite high. I have to say that the autocomplete or the suggested responses in Microsoft Office aren't always accurate. Not that long ago, my boss emailed me with a question, and the first two suggested responses were, "I don't know," and "I have no idea." So it's not foolproof, but it is pretty accurate. moving towards what our managers who are using language-based AI tools for, they have a vast range of performance enhancing, productivity enhancing tools that they use it for. So I'll give a few examples here. So one thing that they can do is, if a fund manager is interested in potentially investing in a certain company, well, they'll have broker reports on that company from multiple sources. And so they can ask the AI to read all of those reports and summarize them very quickly. AI can even read the news as it's being reported and interpret that, and potentially even trade based on that news. One of the things that I found really interesting is what I'm going to call analyst GPT. So if you think about a large stock picking fund manager, so they will have a number of stock analysts, and their job is to analyze stocks, not surprising. And part of that job is actually doing the analysis, but a big chunk of that job is also taking phone calls from people, or replying to emails to answer questions about their research. So what some of these fund managers have done is basically load all of that data into a large language model and train it on all of the research and additional information that the analyst had provided. And then other people, instead of calling or emailing the analyst, they can just, the way you'd be familiar with ChatGPT, is to just ask the AI questions that they would have asked the analyst. And there's two key benefits from this. One is you get the answer straight away without having to wait for your email to be responded to. And the other is it frees up the analyst with more time to actually do their analysis part of their job, rather than replying to the same email for the 10th time. So I think that's a really interesting productivity enhancement, and just allows those fund managers to make more informed decisions when they're selecting stocks for the portfolio. Another thing that I've seen developed is what's called ThemeBot. So if you use the idea of in a gold rush, you go and invest in the companies that make the picks and the shovels. So if we use the example here of, say, well, if a fund manager wants to invest in the AI theme, they can run the ThemeBot, and it will look through the entire supply chain of a company like Microsoft or Nvidia, and actually give you, in a matter of moments, all of the companies that are potentially economically linked to the theme that you have in question. And another one that we've seen is having an AI listen to all of your team meetings and record the words that you're saying and the way you're responding to questions. Over time, the AI will actually be trained on each individual in those meetings. And then eventually, once there's enough data has been built up, once you're invited to the meeting, you can select to go in person, or you can send your virtual avatar. And the people I've spoken to who are using this kind of technology say it's quite spooky how accurately it will reply to questions or participate in conversations as their avatar. Another fun thing you can do is anybody who's has a lot of writing in the public domain can also attend your meeting. So you can ask to have John Maynard Keynes or Warren Buffett attend your meeting and contribute to it, which is quite fun. On the other end of the spectrum, we have managers who are more quantitative, and they're using machine learning tools in particular to try to predict prices or relative performance of stocks and portfolio construction in that space. So sort of thinking your quant investors. And prices are much, much harder to predict. And in part, that's because there's just a fraction of data available on which to train a model. So it's sort of, you think about, well, we've got 100 years of stock data. that seems like a lot, but if you're using monthly returns, that's 25,000 data points. And if you then have 1,000 stocks, then you're only up to 25 million data points, which is just a tiny fraction of the data that's available to train language models. And that's one reason why applying artificial intelligence to the quantitative side of investing is much more difficult. There's also other aspects, such as markets are actually quite efficient. So the sort of things that our fund managers are using AI for on the prices side of things. One example would be for a given trade. So I want to buy $1 million worth of stock XYZ, then the AI will actually look through all of our own prior trading data, and it will suggest which broker to use, whether to trade on a discretionary basis, whether to use an algorithm, and hopefully improve the implementation of that trade. So basically, you're buying the shares for a cheaper price, which then flows through to returns. Another thing that the AI can do is in the form of being a coach for portfolio managers. So if you train the AI on market cycles and what economic data is like, it can actually suggest to the portfolio manager, well, when the market was like this in the past, trades like these or portfolio tilts like these tended to do well. So it's then up to the portfolio manager whether or not they actually want to implement that. But it's like having a second opinion that's able to see all of history all at once. So if AI was as good at predicting prices as it was language, then the results would absolutely be off the charts. But even so, these machine learning models can deliver meaningful increases in return at a given level of risk. To use portfolio management jargon, we're talking about increases in the excess return relative to risk of about 0.2. So it's increasing the Sharpe ratio by about 0.2, which is quite a meaningful improvement because it's very hard to do that. One thing that's coming out of all of this research is a change in the way that quants are actually building their models. So previously, it was sort of the way to approach things was use the fewest number of explanatory variables. The simplest model was deemed to be the best. That's the principle of parsimony. So, for example, if I'm building my stock portfolio, I might say it's 6 units of value and 4 units of trend or momentum, and that's how I'm going to build my stock portfolio. But what we're seeing, and there are an increasing number of academic articles to actually back this up, that in this new machine learning paradigm that we have, and the tools and the scale of compute power available now, the scales are really tipping towards using highly complex models with thousands and thousands of explanatory variables, sometimes even millions, and the results are really impressive. So that's a summary of the way that we are seeing our managers use AI tools, and looking forward to answering some questions. Thank you.
Okay, thanks very much, Stuart. So it's over to Socrates now, who will discuss WealthPilot's approach to machine learning. Over to you, Socrates.
Thank you, Mike. Yeah, very exciting times indeed, I think, at the moment. I'd like to start by saying that AI and machine learning in the investment space has been around a very long time, and many of the largest global asset managers have for decades been investing very heavily and have created very sophisticated capabilities around this. There are many strategies that have been embedded, with AI technology in products that I think a lot of attendees today are using in their portfolios today, particularly around the alternative space. But this requires a lot of scale and serious capability with specialist teams to be able to develop and operate it. A lot of these innovations are also kept secret, and it's a key source of competitive advantage. So ideally, what we'd like to see is some capabilities being deployed, using the new exciting innovations that are occurred through large language models. But I'm not sure how much of this is going to be available in the near term, and the scope of the use cases extending beyond just providing insight and efficiency gains. So I think solving the end-to-end investment process problem is a more kind of challenging and more expensive problem to solve. From a retail advisor portfolio management perspective, look, there's not much available, and the technology is, really much being reserved for the large institutions. I think this new AI technology around generative AI, which is now very accessible, it's making it very exciting, and it's going to be game changing. But I think you're still going to need, pretty heavy sophistication to drive the step change in portfolio management. So I think this accessibility problem is going to get worse, and there's a large gap that's kind of rapidly growing, this chasm, I think, is going to get bigger. Most of the kind of innovation by these big is being done by these big global asset managers, and they're putting a lot of money into it, and a lot of it's being used, I think, for internal consumption to drive alpha. So, looking into the future, you hope that you're not, running around with a bow and arrow when competitors are, those big institutions with, that have aircraft carriers loaded with F-35 stealth fighters. So this means you will need to find a good arms dealer to be able to compete. At WealthPilot, we have developed, tested, and are operating this type of technology with real money for many years. And I think it's a lot of, I think it's the type of technology a lot of people have been dreaming about and looking for. I'm not sure, most people will be hearing about WealthPilot for the first time. We've deliberately been in incognito mode for a while now, despite the fact that we've been building this technology for almost a decade. I'll briefly explain what WealthPilot is and how we've thought about solving this problem with our solutions. Our technology asset is a very powerful AI that we have developed for investment research and decisions. It's a much broader capability, though, that focuses on digitizing and optimizing the end-to-end investment process for operating multi-asset portfolios, and it enables exciting investment strategies. These strategies, however, don't need mathematicians or scientists to explain how they work, and they still fit into what's known as best practice. And this can be, pragmatically employed for usage by advisors with fund investors. So our purpose is to create portfolio management excellence for advice businesses by arming them with this capability to unlock the power of AI for their clients. So when we talk about portfolio management excellence, we're talking about making it accessible, removing the barriers to have access to this, but providing a simple, cheap, and easy to use and explain solution. That also employs a powerful investment process with enhanced investment strategies, and delivers better client portfolio outcomes through better performance. We're talking about portfolio management. If we look ahead, it's becoming, I think, riskier to do, particularly when you look at things like the Your Future, Your Super benchmarking framework that's been rolled out to the superannuation world. You're kind of going to need, as an advisor, some serious capability to be able to compete, I think, moving forward, and a robust investment process to really reduce that risk of managing portfolios. So we focus on personalization as well. Personalization is critical because an advisor is delivering personalized recommendations to client portfolios. So taking the capability and personalizing the research and the decisions is quite a significant change. Toby, I might get you to jump a few slides ahead. So the way we put our technology together is, sorry, Toby, you have to go back a bit to further back on. That's it right there. Yeah. So what we have is a capability around operating client portfolios on platform. So this is really made up in two ways. One is our next generation intelligent model portfolios. So what these do is they provide the framework for advisors to run their own investment process and use their own internal research. But they provide the tools and the framework to be able to do this in a much more efficient way. So here we're really talking about automating personalized portfolio reviews, but using the research provided by advisors. It's a far more flexible approach than traditional model portfolio infrastructure. We're able to make much more kind of smarter decisions bearing in mind the client circumstance. And the efficiency provides responsiveness and control. Might get you to go to the next slide, Toby. This helps, I guess, provides a new level of responsiveness and helps kind of manage this dispersion risk in client portfolios. The way we're using AI here is we're using it to perform rebalance of portfolio, so employing smart strategies to run the rebalance. It's obviously being used, particularly large language models are helpful here because they're able to help automate information gathering and insight production. And we're also using it to generate very personalized portfolio recommendations based on the profile of that customer and the way they'd like to be communicated with. We also have advisors that are using scripts generated by the AI from the portfolio review to actually create a video of themselves that then gets sent to the client, which the client can view and then schedule an appointment if they feel necessary. So there's some exciting things happening there. The way we think about this, it's a plug and play architecture for research and other AI engines that can be kind of integrated into the investment process and moving forward. So the more exciting part to the story, I think, is our AI powered portfolios. And there's a big difference here because what we're talking about is actually handing over the investment process to AI to run. So this includes the research and the decisions as part of the portfolio review. So it's fully automated. The research is powered by an AI engine. The AI is driving portfolio-wide optimization decisions. And look, there's no more research for the advisor to do, and it's saving a lot of time. It creates a very robust, exciting investment solution for clients. So the way we're using AI there is, I think Stuart talked about, your more kind of traditional approaches where you're using a systematic investment process. Systematic is good because it's evidence-based, and it really, puts us the science behind how it is that you run your portfolios the way you do, and provides evidence around why that makes sense to do so. So it helps you explain why you do things the way you do and how each decision was made very clearly. It also gives you an understanding of what expected behaviours can be in different market conditions. So that's quite powerful. And it also provides a really good framework to deal with uncertainty, which is important in volatile or downward market situations. It's also objective and fact-driven, and it takes out a lot of human biases, which can cause errors in judgment. And it's really good from a kind of transparency and compliance perspective. We also have the Electra Fund, where we basically take the constraints off the capability where, in terms of client accounts on platform, we have an innovative fund product that's running 5 mandates, one for each risk profile, using a diversified multi-asset portfolio. And what we're doing is we're combining this with industry experts like Michael to really control and use the AI technology in its kind of best form. I guess what we've done here is we've really reimagined what a fund could look like. When you look at the investment strategy we're running, we've rethought the investment strategy, we've taken out costs, and we've actually recasted the fee structure. So there's no fixed asset-based fees in this fund. It's it's just based on a performance fee. So we have alpha, we can build the business off the alpha. It's also because we're in control of all the decisions that are being made in a fund, we're able to employ far more sophisticated strategies, open up to a global universe, and perform more frequent optimization changes. So they're kind of our 3 main solutions. Toby, I might get you to skip over the next slide. one more. So go back one, mate. Sorry. Yep. So here we have Alex. So what Alex allows us to do is he's an example of the type of AI that we've created for investment selection. Alex is fast, cheap, and super smart, and his job is to perform portfolio optimization reviews. Unfortunately, he doesn't talk to you and he will not make you a coffee, not yet. And unfortunately, he's also invisible and unbeknown to the clients that he manages portfolios for. But he does make the financial advisor of these clients look like a total rock star because of what it does. He does a lot of work for the advisor in managing the client portfolio. He's constantly keeping an eye on things and making adjustments as necessary through frequent portfolio optimization reviews. Clients know there is an advisor doing the best job they can, and they can see the amount of work being done in those exhaustive and comprehensive reviews. This provides peace of mind through a powerful, repeatable investment process that safeguards clients' portfolios, but also creates exciting return opportunities through frequent optimizations. So let me explain a little bit about how Alex is created and how he does all this. Alex represents digitization and optimization of the investment process. He knows the optimal way to implement the investment strategy he's asked to operate, and he precisely applies the investment process to individual client accounts to perform portfolio optimization reviews when required. This involves those steps on this slide in the blue box. So he's gathering the information, he's taking the client account with the particular circumstance, checking all the data, performing analysis and research, building insights off that, looking at current operating risks, and making changes on investment selection. He also looks across the portfolio, makes portfolio-wide rebalance adjustments, generates a recommendation, checks the recommendation, and then gets the trades implemented and the advice documents automatically provided. Once he's done that, he's also on an ongoing basis monitoring the portfolio for health. So he's doing a lot, but Alex performs these steps so quickly that he can perform thousands of different portfolio reviews for different clients every second. The way Alex was created is even more exciting. We took a specification of the investment strategy as a starting point. This means he had a clear objective and mandate that he implements. In this case, he's designed to achieve benchmark outperformance over the long term with highly correlated market returns and uses a momentum factor-based investment model. His mandate is to optimize on the large cap 200 ASX stocks, hold only the best 3 stocks that are best suited to achieve the objective at any given point in time. He uses a traditional quantitative performance data with qualitative research overlay in the investment process and implements a relative stop loss strategy. He's also been optimized. This means that he knows that he can do things in the best way possible. There are millions of techniques that can be used to deliver the mandate that he operates. And these are defined by the range of analytical and trading models that could be combined to implement the mandate. Alex has assessed all of these by stress testing each one to find the best performing technique for the given objective, thus holding the evidence of how he does this and why he does what he does is, and how he knows what he does is optimal. So here, WealthPilot is very similar to a Formula One team. There are kind of lots of ways to tune that car to arrive at the circuit. And how does that kind of Formula One team know that the portfolio, the car is actually tuned perfectly to the market conditions? So this is where we do rigorous stress testing to build knowledge around that to make sure it's optimized. This is called machine learning, and it allows us to adjust and evolve through the race as the knowledge is obtained and evolved. Alex is then deployed to advisors to run portfolio optimization reviews by assigning him to client accounts. We allow advisors to build their own AI, like Alex, that implement their particular investment mandate and strategy. Might go to the next slide, Toby. What Alex allows is an ability to operate a new innovative, very powerful type of investment strategy called active optimization. So What it means is that we can efficiently perform frequent and exhaustive portfolio optimization reviews that apply the investment process to rank and score investments. We are looking at every single possible investment option and switching to the best investment when you're using an AI like Alex. So this ensures that the portfolio is always optimal for the market conditions. Now, Alex can be configured to use a wide range of indicators in its investment process that can be tailored to the needs of the investment advisors he serves. These indicators allow Alex to rank and score investments so he can apply his selection and switch decision overnight. Alex, of course, can operate many different types of sophisticated trading strategies, but in this simple example, he would be holding only the top 3 stocks, meaning he would be selling NAB and ANZ to buy either CBA, BHP, or Rio. What this means, I might get you to go to the next slide, Toby. This will be my last slide. Is we're able to employ a new type of very powerful diversification strategy to keep portfolios continually optimized. We've really rethought portfolio construction by employing AIs like Toby, like Alex, to operate specific active optimization strategies within components across the portfolios. This allows advisors a new level of precision and fidelity in portfolio construction that enables creating a powerful type of diversification strategy. Advisors can use lots of AIs like Alex to perform continuous investment optimization on different types of securities using different strategies across the portfolio with different mandates and objectives. In this case, across managed funds and direct equities. Here you can see the Australian equities asset class where we run 2 different active optimization strategies over the universe of 124 large cap fund managers to ensure that the optimal manager is being held for the given objective. Component A is targeted on uncorrelated returns focused on downside protection on a short-term low volatility factor, whereas component B is focused on an unconstrained return on a long-term risk-adjusted performance factor. Now, these 2 components will optimize the manager configuration to achieve a particular objective every time a portfolio review is performed. Both have different allocations that can be adjusted by the investment committee when required. We have thousands of off-the-shelf strategies available for all the different platforms that advisors can choose from to use in their portfolio designs, or they can create their own. The result is portfolios that are much more diversified, responsive, and adaptive, and this over time delivers superior performance. It provides a powerful canvas for advisors to find a clear and precise investment strategy tailored to the client needs, philosophy, and particular behaviours they are seeking. This precision is quite useful when talking about portfolio performance with clients and allows advisors to demonstrate an exceptional competency in their review conversations. Feedback is that clients always choose the portfolio using active optimization over set and forget approaches, particularly when they see some of the performance benefits being explained. And it's an exciting portfolio solution for advisors to use with clients. In terms of the benefits, it enhances trust. It's delivering better, more reliable return, and advisors can kind of see, clients can see the work that's being done. Benefit to the advisor is it's strengthening the investment solution value proposition, creating a big point of difference for arming them with the institutional grade investment process. So yeah, that's how we use AI at WealthPilot.
Well, thanks very much, Socrates. So now we can move along, and we'll be talking to Michael Strachan. Michael, over to you, and talking about the desire for human intervention.
Thanks, Mike. Look, I'm probably incongruous in being here as a panelist because I'm really an IT and AI Luddite. However, I have been in a hands-on fund manager as well as investment markets for well over 30 years, and have been through with my business partner, Andrew McQueen, every business cycle since the 1987 crash. So as a consequence, we've got a lot of welts on our backs and mistakes we've made and learned from. My role actually, as with Socrates, is actually Andrew and I are on the investment committee for the Electra Fund. And the way I sort of view it, compared to a conventional investment committee, our job really is risk management. And that is, what I mean by that is that the robots, as Socrates likes to call them, do their job and they do it very well. The issue is they quite often bring up things that may look equivalent when they're actually not. So our view is to say, righto, we need to have a deeper dive, and the system allows you to do it, what the actual portfolio holdings are, and make a decision from there. So in effect, for the technology is fine. The issue it will come to is actually the data input, and I'll come to that in a moment. But our job is to have we're really a sanity check. The other thing we contribute to them is this is designed to select product and put a portfolio together. It is to actually input into the asset allocation decision and also our views on markets, because markets don't look backwards, they don't look forwards. So, for instance, robots do their job, but with all the different factors in a rising interest rate market, when rates started going up, just from years' experience, the places you do want to, but what do not want to be, include small and micro caps as well as emerging markets. So our view is, well, we've got the robots for those. Should we downweight them? So that's basically the human intervention, but really our job is really mismanagement. The problem, I suppose, over the 2 and a bit years we've been doing this with Socrates, and probably a frustration a bit for all of us, is actually the database and the equality and integrity of the classification system of the database. The technology is doing what it's designed to do and does it extremely well and efficiently, as Socrates mentioned before. Electra uses the Morningstar product database and classification system. The issue with this is that a lot of the classifications are misclassified. What I mean by that, a lot of things that are in global equities, you've got apples and oranges. And the way I look at this is that it's possibly because a lot of people who make the categorization decisions generally have little or no hands-on money management experience. And in doing so, they don't really understand a lot of the subtle nuances between different products and how they should be classified. So the issue really has been is that the system works, but the reason we've actually had to see what is being proposed looks reasonable is basically the quality of the data input, or it hasn't been really classified accordingly, so you're comparing like with like. And it's not only Morningstar, I've had experience with the Lonsec product classifications, and they're very similar. So that is one of the issues, the lesson is you've got data integrity. Now, just to reinforce this, I was actually at the Australian Dairy Conference last year, and look, that's because I sit on the board of the Garden and Dairy Foundation. But they had a session on AI in agriculture, and this same issue came up. This guy presented and he said, righto, let's see AI in agriculture. ChatGPT, the question was, how much water is required to produce a kilogram of beef? Well, the answer was 15,400 litres. All right, now, even I mean, when you consider most cows weigh about a tonne, that's a lot of water to consume. But what he pointed out was ChatGPT is doing its job, but it's been trained to use the internet. So not only is it picking up scientific research and agricultural research, it's picking up activists' opinions and everything else. So you really need to be very careful what you control and put into the system. Probably the other observation I would have is that AI is very powerful. It will continue, and it'll be like when we started with the internet 20, 25 years ago. We wouldn't have been able to get through the pandemic and conduct business if it hadn't been for the development of the internet and Zoom and Teams and all the rest of it, and the broadband capacity. But the issue is that my experience is good investing is part art, part science. Now, which means you've got I've got a lot of grey hair because I've made a lot of mistakes. So the issue for me for AI is actually the challenge is to incorporate the art into the science. Now, for instance, a lot of people, when they use quantitative or type processes, backtest, and they're using historical data, that's fine. The issue with this is that a lot of it assumes markets are cyclical, and most of the time they are. Being through the different crises, the factors are slightly different, but the behaviours and other remain the same. What it doesn't pick up is structural changes in markets, and this is when you need to have the capability to learn or make assessments. And a very good example of this is quantitative easing. No one had ever tried it before. There was no history of it or what would happen. And so I was CIO at Equip at the time, and we made the decision to go long equities, and for the next 10 years it went very well. I mean, the issue being is that when you're in that sort of interest rate environment, valuations, whether you like it or not, are going to increase. And we're living with some of those issues now when rates have gone up, particularly in the property sector. So at the moment, AI is a very powerful tool that will develop further, but there's still a need in certain areas for some human judgment, and that's basically my role. Well, as I said, no doubt it'll continue to progress, but I think when Socrates has achieved his objective, he would have made Andrew and I redundant because the system would be doing all what we do. Thank you.
Well, thank you, Michael. Yeah, the human element is always important, and I'm intrigued by at least one of our questions here. Was Socrates speaking or a virtual assistant? I'll just throw that out there, Socrates. Were you real or virtual? That's one anonymous attendee asking the question.
Look, if I was real, I think. Sorry, if I was virtual, I'd be a lot better looking, wouldn't I?
Absolutely. Look, I think we've got a number of questions there. Let's have a look at something we were talked about a little bit earlier, and what do we think the future of AI is in investment management? Is it going to give managers the is it going to give them the competitive edge in terms of cost and skill? And I guess that's something, Stuart, you addressed somewhat, but is it going to give it the edge?
It's my suspicion that it will. So the managers that we're seeing really making great strides in this space are the ones that have the scale and resources to throw at the problem. So it's really the big fund managers and the more tech savvy managers. And assuming that the results continue along the lines and the evidence that I've seen so far, it's hard to imagine that in, say, 5 years' time, that pretty much all managers will need to have sophisticated AI tech embedded in their processes in order to remain competitive. And I don't see AI as becoming like this self-aware artificial general intelligence or anything like that. I think at the end of the day, it's a productivity tool that can be applied at scale. And so it's sort of no different to when fund managers started using spreadsheets and Microsoft Excel and Python in their investment processes. It's just you have these new, better tools coming along, and you have early adopters who have sort of a leading skill set in this space. And then as more and more people learn how to use these tools, and also as usage increases, cost comes down, and then it just becomes available for everybody. And I think just asking the AI a question is probably going to be an alternative to asking your grad to go and do a bit of research for you, and it's probably quicker.
Socrates, I'm interested in your view on that. What's your thought?
Yeah, look, I think it's it is driving a huge productivity gain, and I think what it's doing is it's elevating the role of the human. It's allowing the human to go and focus on much higher risk decisions, particularly in portfolio management. So yeah, look, there are strategies you can run that are automated, but do you want to be running those strategies, particularly when you've got someone's life savings that you're trying to make decisions on? So I think it's a risk management exercise fundamentally that will tell you that you need human intervention in this stuff.
Another question here. Socrates talked about having a menu of standard mandates. How are they actually developed?
Yeah, so look, we call these building blocks. We develop those through, I guess, a combination of two things. They're a common set of objectives everyone's trying to achieve. So we've kind of canvassed those and used those as the basis for creating those mandates. But there's also bespoke objectives that our customers want to achieve. So it's a combination of letting the kind of feedback drive what those mandates are, as well as having kind of best practice industry ones.
Okay, and one here from David Hawksworth, which I could almost take as a comment as much as a question. Are there even going to be a need for financial advisors in the near future? This is making me consider I may need to find a new job in 10 years, or likely few years off. I think that was kind of a sentiment expressed yesterday as well. Do we see AI replacing advisors, or do we see it as just a tool?
I would say for financial advisors as well as portfolio managers, you still need that human judgment and holistic view over the top, but every one of us will need to be conversant, is that the right word? Be able to use these tools, because it'll just be, it's it will just become part of the role.
I think, Michael, you kind of addressed that. Your view is that the human factor needs to be there.
It is, and also just on your question, when I was at Equip, I introduced robo advice. It was my personal view was I thought it wasn't the AI that wasn't as developed as AI systems are now. But at the end of the day, you still end up going to be bespoke, and people like to speak to somebody. Well, my generation at least, rather than actually do it via in person via a computer. But you really need to know everyone's personal situations. You can actually optimise the portfolio, what is best for them and their needs and requirements. So I think there will be a need still for financial advisors. I don't think the technology will actually override that. But as was said by both Stuart and Socrates, it's certainly going to see massive productivity improvements, and also availability much more to be able to bespoke easier than previously. So the current, like a lot of model portfolios, one size fits all, well, that'll evolve.
Okay, well, we've come to the end of the questions and we're nearly close to time. So, Toby, I'm going to ask you to resume control, and thanks very much to our panelists. Thank you.
Thank you. Thank you very much, Mike. Thank you, Socrates, Michael Strachan, and Stuart Eliot from AMP. I mean, what we've heard today is two organisations, AMP at the largest end of the multi-asset class portfolio management universe, and Socrates at the other end of the continuum, talking about AI and the way it'll play out in portfolios developed for individual clients. Coming up tomorrow, Cameron Gleeson from BetaShares and Monica Techa at InSync will bring their perspectives on AI, both within a funds management business, and we heard a little about that today, and AI as an investment opportunity, and the way in which the opportunities that AI offer should be absorbed into portfolio management. And then, as I say, in March, our portfolio management conference. So Mike Taylor, Michael Strachan, Socrates Vossos, and Stuart Eliot, thank you very much for your time today, and we'll look forward to having you all join us again tomorrow. Thanks very much.
Thanks, Toby.